At this point, I'd like you to also complete the cash flow statement for this exercise. Now, if you go back to the completed exercise, you'll see that we have the income statement on a book basis and the balance sheet on a book basis, which is what we just completed. And I'd like for you guys to build a cash from operations section. Recall that we talked about the classification of deferred tax liabilities and deferred tax assets on the cash flow statement and where that is from the prior videos. At this point, we want to figure out how to get from accounting GAAP-based net income to cash from operations. In other words, cash in my pocket. So the way to think about this is similar to what we talked about in the prior video, which is you have cash revenues and expenses, and then you have this cash outflow associated with taxes. And so if you take 2015, for example, and you see that you have $50 in cash operating profit minus 14 in cash taxes, you're looking at 36 in cash inflows. So we know that this is going to be the end result. So we know, so I'm actually going to start you guys off on this and let you guys give it a shot. So we know that this is going to be the final answer, and we know that we start with that 24 in accounting net income. Now the question is, what is the appropriate way, what adjustments need to get made in order to get from that 24 to 36 and so on and so forth for the next 3 years. So hit the pause button, give that a shot, and then we'll go over it together as a group. Okay, so here we see that to get from 24 to 36, the first major add back on the cash from operations section is depreciation, as we've talked about in basic accounting. So we add 10 because that represents a non-cash expense on the income statement, the reduced net income, but should be added back to get to cash in my pocket. So at this point, I've accounted for $34 million worth of cash. But of course, the other adjustment is recognizing that because the balance sheet deferred tax liability went up, that represents that that the income statement is being understated because the tax expense line on the income statement was too high. And so to get from net income to cash from operations, we add the increases in deferred tax liability. So this represents the annual change, the annual positive change in DTLs, right? So that's the result here, and that's what gets us to 36. Now there was no change in this year to get from the DTL started the year at a balance of 2 and it ended the year at a balance of 2, so there's no change there. But in this final year, when the DTL is finally reversed, that gets reflected as a reduction, right? The DTL went down from 2 to 0, and so we have a $2 million outflow because the tax expense that arrived at this net income is actually lower than the actual cash taxes that have to be paid during the year.